Since 1960, PEs have trended lower when inflation is higher, with year-over-year core PCE now at 4.6% and S&P 500 trading at 19 times. We should see stocks fall another 20% by mid-October if historical seasonals mean anything. We welcome in Mr. Minard right now. He joins us in a CNBC exclusive interview. It's great to talk to you again. A rather ominous warning. Why now?
Well, Scott, look, first off, when you're looking at history, and that's one of the things I try to spend a lot of time doing, it really is stark to see the price-earnings ratio where it is. And why right now? Well, this is seasonally the worst time of the year. And August, September, October are the worst performing times for the stock market. And, given the recent strength over the last few days, it just appears that people are ignoring the macro backdrop, monetary policy backdrop, which would basically indicate that the bear market is intact. And given where seasonals are and how far out of line we are historically with where the PE is, we should see, I think, a really sharp adjustment in prices very fast.
You're basically saying there's no justification for why stocks are trading at what you think is an elevated valuation, whether it's to where they should be now or relative to history, because you don't believe that earnings are going to be able to be sustained at these levels.
Exactly. And the other thing, too, Scott, it's interesting. The PE that I'm looking at in the tweet is the trailing PE. And so we're looking at the comparable data for the market with a trailing PE. So the argument could be, hey, we're going to see earnings pick up, and that'll help the price-earnings ratio. But, given the backdrop we're in, which we may very well already be in a recession, I don't see earnings picking up dramatically. And actually, I see some downward pressure on earnings coming out of energy and other sectors where we've had price declines. So, the four most dangerous words in investing is this time it's different. And this is just so stark from history. And when I was on the show with you back in April, we were talking about recession. And I said one of the most important indicators of recession would be if the 3-month bill began to trade higher than the 10-year note. And, as we sit here today, the 3-month bill is, still slightly below where the 10-year note is. But if the Fed delivers on 75 basis points, we're going to have a pretty sharp repricing in the front end. And, we're going to start discounting, a complete inversion in the yield curve.
What do you say to those who suggest, to those who say, like you are, that we may already be in a recession, or that we just simply can't be? The job market is too strong right now, and frankly, some of the economic metrics that we've had of late don't show recession either. So how do you respond to that?
Well, I think there are two factors here that we have to take in consideration. One is productivity. Productivity has just been abysmal. And so we are getting more people back to work, but we're actually seeing a decline in the output per worker. And so that's obviously a very important component of corporate profits. The other thing is that the employment indicator is a laggard. And that is that we tend to see unemployment rise as the recession just gets started. So, or after the recession has started. So, I think at this point, a lot of the things people are pointing to are what I'll say nominally positive. You look at some things like, some of the components of consumption, other things like this, wage growth. But at the same time, inflation is running so high that in real terms, these are actually negative numbers. And that's how we measure GDP in real terms.